person, Utah-based CPA firm, Bruce. Bruce, one of the partners at the firm. Bruce, want to take a minute and explain what you do and how you do it so well?
Yeah, you bet. Really quickly, my name is Bruce Gulso. I went to Weber State for both my undergraduate degree and my master's degree in accounting. Here at WSRP, I kind of wear two hats. I focus mainly within our tax department and tax and compliance work, tax planning, mergers and acquisitions, structuring deals, those kind of things. Beyond that, I also oversee our business valuation department. So I am credentialed in business valuation, deal with that for a number of different reasons, estate and gift purposes, merger and acquisition work, exit and succession planning, litigation support, you name it. Anytime there's a business valuation that could be needed, we're able to provide those services as well. Like Bob said, we're about a 100-person firm. I've been here with the firm for going on 7 years now, almost 7 years. Been a great place to learn and grow, and we serve the Wasatch Front is our key focus, but we have clients all throughout Utah and actually all throughout the world. We do audits for banks in Kazakhstan. We really have an international reach, but at the same time we're focused here on the Wasatch Front.
So local firm, wide reach. I don't know if Bruce mentioned too, we're also part of the BDO Alliance, which gives us a really deep set of bunch of resources to get into across the country and internationally. So I want to talk a little bit about what's happening in the workforce. This slide is just a little bit of a summary point. Look, in the U.S. workforce, 31% of the employees, 31% of all the workers in the U.S. workforce are employed by these 5 industries. Now, we picked these 5 industries because they're flourishing so well in the pandemic. But the point is, the restaurants, the airlines, all these industries are really getting hit pretty hard right now. The other part of it is, do you have customers in these industries? And how about the customers and the clients that these people are actually servicing, and how do they trickle into this? The reason we're bringing this slide up is there's a lot of change. So whenever there's change, it creates challenges as well as opportunities. So one of the things we need to look at if you're looking at growing your organization is, how is this going to impact you as you go forward? And are you accounting for this in your overall growth plan? And will some of these things begin to impact you? The other thing we're going to talk about next is missed payments. So I'm kind of setting the tone a little bit about some of the changes occurring out here. About a quarter of the Americans have taken some advantage of a payment deferral program. That could be a missed car payment, credit cards, any kind of bank payments, anything along the line. That's 1 out of every 4 Americans are doing this. 6 million missed their mortgage payment or rent payment back in September. Now, I know it's December, economic numbers lag a little bit. There's probably some updated October numbers, but quite frankly, that $6 million number, that has been going on for a couple months prior to this. So I can't imagine it's done nothing but increase in this environment. 26 million missed their student debt payments. Now that's a little bit of a misleading fact because some of the student debt payments were put on deferral by the government, but it's a huge number. The shocker is the one at the bottom. And a third of the Americans believe that they're looking at foreclosure in the next several months. That's from the U.S. Census Bureau. And back in the days when they were still doing the vice presidential debates, one of the things that Kamala Harris brought up, which I caught special attention of because we like to play with these numbers, she said almost 50% of Americans are looking at some kind of eviction or foreclosure. I thought that number is aggressively high. I think the 33% is aggressively high, but cut the 33% in half to maybe 20 or 15. That's still a lot of people in this country that are facing a lot of economic crisis. And we don't want to paint all gloom and doom, but we just want to be able to set the tone as to where this could go and how some things can be recovered. So, shot ahead there a little bit, Bruce. Bruce, you want to talk a little bit about fraud?
You bet. Thank you, Bob. Yeah, so one thing that we're seeing, and we're hearing from the banks that we work with and the CEOs and controllers that we work with, is we're seeing a significant uptick in fraud related to the pandemic. And some of this goes back to the fraud triangle. And if you've heard about that, really that there's 3 pieces to fraud. But really the big one that's starting to come up now is maybe you had a family with 2 incomes that's now reduced to 1 income, and there's additional financial pressure. as Bob alluded to earlier, there's a number of people that are missing their mortgage or their rent payments. And so the opportunity for fraud, well, it may have been there previously, is being taken advantage of now that you have individuals and Americans that are facing these economic hardships and economic burdens. And, but beyond just the fraud related to what, you might see in-house, maybe, stealing money from an employer, those kind of things. We're seeing a huge increase in fraud for online services as well. You got to think everybody's staying at home, everybody's ordering just about anything and everything that they can off of Amazon. Well, this presents another opportunity for fraudsters to for phishing schemes or to try and get your sensitive data while you're ordering from maybe some of these organizations. But the second bullet point there, one that's a big one, is the 41% increase in unemployment fraud. This one ultimately, I think, is going to come back and bite a lot of people that are committing this fraud, just because currently the unemployment systems are just overwhelmed, and they really don't have the ability to properly screen every applicant that is coming in. Another item of fraud that we're seeing, and we'll get into this maybe a little bit more, is the PPP funds that came out. It seems like we're starting to hear more and more stories of how people defrauded the government to acquire the loans and then use the funds for inappropriate purposes, whatever those purposes might be, a vacation, a new car, their house payments, rather than using it for the purpose of why it was put there, which is to keep employees employed. This really, seeing this fraud, we're seeing a lot of clients that are coming to us and saying, all right, maybe it's a good time to look at our internal controls and make sure that we have the processes in place to ensure that we're not going to be subject to the fraud that may occur. Just because everything's been going well in the past, maybe it's a good time to take some time and look at your internal controls. Sit down with whoever your accountant is. If you're having reviewed or audited financial statements, it might be a good time to sit down with your accountant and have them look over your internal control policies and make sure that you are following best practices within the industry for the various functions within your firm.
And just to throw some points out there, Bruce. The average theft and fraud goes on for about 18 months. That's the average cycle that goes on. Loss is about $150,000, and that significantly varies based on where that fraud is occurring from. But the thing that really gets you is that why I think fraud's on the increase is a couple of reasons here. One is I'm getting paid less now, perhaps, in the organization I'm with, and I've got access, so I feel a little bit. I'm feeling unjustified, so I took the pay cut and took advantage of it. But the second thing is, there's a lot of people that are having addictions of some shape or form that they need to continue to do, or they have somebody, they got a significant other that's got a health issue they need to fund. And as the revenues begin to shrink in some organizations, the fraud that may have been occurring all along begins to surface and rise up more. But the one thing, like ADP sent out one of their surveys, and one of the surveys is digital banking is up almost 200% since the pandemic. So people that didn't go to the bank before now are finding that all the stuff's all online, as Bruce said before. It's not just ordering through Amazon, it's the fact that I'm doing my digital banking, everything's exposed. So the weaknesses in my own systems, my password protection systems, become much more available for outside hackers to hit this. Bruce, let's talk a little bit about the PPP, because you can't have enough PPP discussion these days.
Yeah, right. Yeah, one of the the CARES Act that was passed back in March that gave a lot of relief to the American economy. One of the big portions of that was the PPP loan, which was originally structured as a way to help employers keep employees employed. And a side effect of that was to also keep, while we're keeping employees employed, we're lessening the burden on the unemployment system. And as the previous slide showed, there is a significant amount of unemployment fraud. This was designed to help lighten the load on the unemployment systems. But a number of our clients, I think I've only maybe talked to a handful who did not take the PPP money. And they worked in industries where they really were not impacted by the coronavirus. And actually, I shouldn't say they weren't impacted. They actually benefited from it. And when I say benefited, the services that they provide, whether they provided PPE, personal protection equipment, or one of them provided key components to ventilators. So you can see that their business just skyrocketed during the crisis. But the one big misconception that I hear from a lot of clients is that the PPP money is non-taxable. And well, yes, it is structured as a grant. And so if the funds are used for the appropriate purposes, which is to pay payroll related expenses such as health insurance, employer 401k contributions, you can also use it for things like rents and utilities. So that if the funds are used for those purposes, the loan will be forgiven, and you do not have to include that loan as income, the cancellation of debt as income for tax purposes. But the caveat is that the IRS came out and said, well, while you do not have to include that, the forgiveness in income, you also cannot take a deduction for the expenses that the funds were used to pay for, which in essence makes the transaction taxable. So we're running into this with a lot of clients that are saying, hey, you know what, we don't have to include this $1 million worth of PPP funds. We're going to break even for the year. It's not going to be that bad. And we have to come in and say, well, actually, as the law is currently written, you're not going to be able to deduct that $1 million of expenses as well. So now we've got a situation, if we're using an effective tax rate of 35%, where that $1 million loan is actually going to cost you $350,000 in taxes. So that's where the loan forgiveness confusion comes in, and where there's some unforeseen consequences when you try and push something out as complex as the CARES Act in a relatively short period of time. Not all of the consequences are really considered, and this is unfortunately just one of the unforeseen consequences. The good news is that the bill that the group of 8 that Mitt Romney put out, that's I think it's a $908 billion stimulus bill, they're hoping has bipartisan support and could pass, includes language that would allow the expenses to be deductible. All along, that was the intention of Congress, that the expenses would still be deductible. However, that's just not the way that the IRS has interpreted the law. And without an act of Congress or some new legislation, the IRS is not going to allow those expenses. One interesting thing with the timing on those is that the IRS has they came out in early November and said if there's a reasonable expectation that the loan will be forgiven, then you are unable to deduct those expenses for 2020. So just because you may not have received loan forgiveness yet, we have a number of clients that are not going to get their loan forgiven until 2021. They still have to disallow those expenses in 2020 because there is a reasonable expectation that the funds will, or the loan will be forgiven. Part of this new legislation they're coming out with will have some additional funds in there for the PPP program. The PPP program actually it ran out of funding at one point in time. They put up some more money to fund it, but and that actually was not completely depleted by the time the deadline, which was back in August. But this next round of legislation, it does include some monies for the PPP. Some impact from the CARES Act that a lot of people haven't heard about is the provisions related to NOL carrybacks. The Tax Cuts and Jobs Act, which was Trump's tax plan back in 2018, did away with NOL carrybacks. They just said that you could carry NOLs, net operating losses forward. The CARES Act came out and said, all right, for 2018, 19, and 20, we're going to permit you to carry back NOLs 5 years and then forward again into perpetuity. But we've had a number of clients that actually had losses in 2018, and we were able to file either, it's in Form 1139, which is just an expedited form. You don't have to actually amend your tax return. And there is actually a fax number to get that to the IRS so that it can be filed in a timely manner. Normally right now, if you're mailing anything to the IRS, you're going to expect it to take anywhere from 3 to 6 months before it's even opened. So they really have tried to streamline the process for NOL carrybacks that can really create some cash for your business if you are in that position where you had a loss in either 18 or 19, or if you're going to have a loss here in 2020. So
hey, Bruce, I'm going to add into that too. That is a very, very unknown feature. I can't say how many accounting firms aren't bringing that up. Banks aren't bringing this up. So it's not just, the whole PPP component of this is if you had you're having a tougher year, you're going to do, when Bruce mentioned, break even and lose money. This is a major way to inject cash back into what you're doing. Also, Bruce, before you go to R&D, I'd like to throw something out to the crowd. Look, we know the organization that you're with here. It would be really helpful if you could maybe just send a quick chat to me about anything you would like to hear about related to your specific profession and how that could impact it. Keep in mind, we've got a large real estate background here as an organization, and there may be some things here that could that we could help you with. So if you got any questions, fire them away with a chat. I won't repeat who said them. I just want to get the topic out in front of the crew. Bruce, go away. Take it away on the finish up the NOL in the R&D.
So yeah, like Bob alluded to, the NOL carrybacks, it's something that kind of I think a lot of accountants missed in their understanding of the CARES Act, just because it wasn't the big elephant in the room. The big elephant in the room was the PPP money and the stimulus checks that each individual got, or most individuals were eligible for. Those were kind of the two big ones that people saw, because it got them money in their pocket right away. Where the NOLs, it's going to take a little bit, but at the same time, it is a great way to get some cash in your pocket. The R&D credits, these are something that we are looking into with a lot more with some of our clients, just because of the way that they're having to maybe change up the process of what they're doing, or maybe adjust their internal procedures to maybe modify the products they're making or the products they're creating. A great example here, when COVID first hit, Tito's vodka. Tito's vodka, it doesn't kill the coronavirus on its own, but they're in the process of distilling and making an alcoholic beverage. They actually changed up their production and assembly line to produce hand sanitizer. And actually, the other day I saw the actual Tito's vodka hand sanitizer, and you can't drink it, but at the same time, it works great to kill the virus. So that's an example of a company taking their existing product line, manipulating it, changing up the process, and that change in the process to figure out how to make something different will qualify for the R&D credits. So just something to keep in mind, that if you are having to change things up, if you're having to do things differently, that there may be some opportunity there. We're looking at a number of our clients, and this might be some folks that you guys are able to work with if you're designing certain systems for individuals, building structures, whatever it might be. If we're having to do things a little bit different, there might be some opportunities there as well. Anything you'd like to add on that, Bob?
No, I think we've covered that one pretty well. Just really keep in mind that there is a lot of opportunity on the R&D side and the carryback side. And this PPP stuff, you got to be really careful how you track and report that, because you get one shot at that one. And if it goes bad, I don't think there's any way to amend a PPP filing, and we deny any of that. Let's talk about the bankers' concerns. Bruce, you still want to handle this one?
Yeah, I'll take this one. Yes, bankers' concerns, that we're running into a lot of concerns from bankers, specifically a couple of items that bankers are concerned about. If you look at the whole purpose of the PPP loan, it was to give companies kind of a bridge, a bridge to keep in business and to keep employees employed. Well, if a company actually took out a PPP loan, are they basically telling their bankers that we're concerned that we're not going to be a going concern, because we had to have this injection of cash in order for us to be able to survive the pandemic? So from a banker standpoint, where you're looking at what is the risk of my client, there could be some big concerns that they actually did pull out the PPP money. One other thing we're running into with bankers in regards to the PPP funds, and maybe this isn't so much with bankers, but with trying to acquire financing, is that, you know, if we go out to a company to maybe extend a line of credit, well, now maybe having this PPP loan on the books is going to throw our debt covenants out of whack. It's going to screw up with maybe some of our ratios that are required under our debt covenants. And is there a chance that the banks might come out and say, all right, well, we're not going to extend the line of credit as we normally would, so long as you have this loan on the books. But given the rules regarding the PPP monies, there's a lot of people that aren't going to be able to apply for forgiveness until their fourth quarter 941s are prepared, which ultimately isn't going to happen until probably sometime in the end of January. So you can see that you may have year-end financial statements that are going to ultimately have to report the PPP funds as a liability on the books, because for GAAP purposes, you can't write it off until it's truly forgiven. And if there's that reasonable doubt that it might not be forgiven, and again, this goes from a GAAP standpoint, not from an IRS reasonable standpoint, then it could be something that the banks might look at. So with that, the loan covenants, how are banks reacting? The other I think issue that the bank examiners are going to have here is, the banks might understand what's going on, and the banks you may be able to work with your banker if you have a solid relationship with your banker. But what about the bank examiners? I mean, the bank examiners are going to come in and say, you've got all these clients that are breaking their loan covenants, and we can't permit this. You really have to go out and call these loans. And so just because you have a great relationship with your banker, that doesn't mean that the banker doesn't have someone breathing down their neck that is going to make them follow the loan covenants.
Unfortunately, that's why the bank examiners are there, to keep that in check. But it's a tough issue. I've talked to probably about 20 banks over the last 3-4 months, different banks, commercial lending groups. And one of the things they've all come up with is universally, they're not sure what's going to happen in 3 months. That's a pretty much almost a universal statement, is they're not sure how this is going to be handled, because right now there's been some grace periods with loans being, forgiven temporarily, or they've given you 3-month forgiveness and they tack it onto the back end of the loan, and that's acceptable to pass through. But that's going to start to stack up, and at some point they're concerned about how they're going to handle this, because they don't want the property back, they don't want to own your company, but they're not sure how to do it. And Bruce's point is exactly right. They got the bank examiners pushing down on them. So unless the government intervenes and makes some kind of change, which is very possible, I think we're going to have a lot more, I'll call churn in the water, meaning more change. The more things change, the more churn occurs, the more movement there is, which means there'll be more potential for more tax strategies to be involved to help some of these companies that may be distressed and helping them figure out how to get out of this. Bruce, anything else you want to add to that one? Or?
No, I think we're good.
All right, selling your business today. So, hey, that PPP thing does not go away. It just won't go away. So companies right now that are in the process trying to sell their business, they have an unforgiven PPP loan. That doesn't mean that the loan, and unforgiven means until they get actual notification back that their PPP loan has been forgiven, it's an open liability, even if they've started the application process, because some of those application processes could take 3 months is what we're hearing. Not all banks are even taking them all through. That open liability has to be accounted for, and it is stopping deals right now. The other part to think about on these selling of businesses, and this is pretty relevant, about 65% of about 65 is the average age for the baby boomers out there, about to turn 66. They own 60 to close to 70% of the companies in the United States. So if you think about it, 6 out of 10 companies that you see are probably falling into some kind of a transition mode with ownership that's got a baby boomer. So either they're going to have to do an internal transfer or an external sale or family succession. 70% of them are going to try to sell to an outside party. 30% are going to try a family succession. Other 30% will be quite a bit of failure, which will end up probably popping back into the outside party. But there's 2 different paths there. The internal succession to a family often turns into a gifting strategy. So they want to set a lower strike price on the company and start gifting some family wealth through the deal. That's not always the case, but it is often the case. The other part, the 70% that are trying to sell to an outside party, most of them have never done it before. So if you've never sold a business before, you're not quite aware of what the process is. Like, I'm going to use the word cleaning up the books. So like a lot of companies will put some things through that maybe aren't necessary or vital and make purchases. And once they're in the expense bucket, you have to stop that. You have to make you have 2 years of clean financials. You got to understand what the value of the company is and what you think it's going to sell for and how you're going to get it to sell for that point. There's a lot of tax planning involved in this. That's one of the things, though, that's hitting this market really hard right now. And just think about a doorway. And if you got a bunch of people trying to jam their way through the doorway at one time, it's going to clog up, and only so many people are going to get through. That's what's probably going on in this country right now with some of those businesses looking to exit. They're all trying to exit. There's only a limited number of buyers, and then the question is, what's the funding that's going to be available? So, personal financial ideas. Bruce, do you have any?
Yeah, save. You know, cash is king. Make sure you got plenty of it in the bank. No, you know, some ideas to consider and things that we're recommending working through with our clients. Tax projections for 2020. You know, for us, it's go season right now for tax projections with our clients. You know, there is a number of, like I said, changes that came out via the CARES Act that to be aware of. You know, we currently have the Tax Cuts and Jobs Act out there as well in the changes that are there. You know, the nice thing to do, or one of the nice things for us is looking at, you know, possibly what could be coming down the pipeline, depending upon what your political affiliation is and what you think might happen there. Not depending upon your political affiliation, but what your belief is of what may happen coming up here in Georgia, and what you think about the Joe Biden tax plan. We won't get too far into the weeds on that guy. You know, look at your prior year returns for those NOLs. You know, and really, if you are a small business owner and you're thinking, well, maybe it's time to get out, or maybe you're thinking to yourself, well, now is not the time to get out because I may have a depressed value given the impacts of COVID on my business, and maybe the top line and the bottom line aren't as good as they would have been if you would have thought about selling last year. So good idea to start thinking about the exit and succession planning that Bob mentioned, you know, and some other items to consider. The evaluation for estate purposes, if you're going to do internal succession planning, or maybe you've got, you know, a family cabin or some property somewhere, you know, it's a good idea to start thinking about what's going to happen with those. You know, part of the Biden tax plan would be to reduce the step up in basis when somebody passes away. So that way it might have some impacts on the estate and gift exemption amounts. And currently under the Tax Cuts and Jobs Act, the 11 million plus exemption that we have for each American is going to go away in the next, I believe it's in 7 years. So we need to make sure that we are considering that now, so that way we can make changes that might need to happen here in the near future to maybe get some assets out of an estate, or freeze the value of a business for estate tax purposes through various trusts and other vehicles that we have to assist there. And, you know, like I said, we've got an $11 million exemption per individual. Could be a great opportunity to gift a portion of a business, or you know, some just kind of, you know, keep get some assets out of your estate, so that way you know your family's not having to pay for estate taxes later on in life. So some ideas there, but really, and come up with a forecast not only for 2020, but let's start thinking about 2021, 2022. Develop kind of a worst and best case scenario that can help you out going forward. You know, if this is the worst case scenario, well, let's hope that doesn't happen. But at least let's plan for it, just in case it does come about.
Yeah, I have to say, Bruce, I've been at this for some time now too. This is probably the most complicated tax planning year out there because of the PPP wrinkle is one, the business changes, the revenue changes, all these different incentives and CARES Act, things like that. Huge impact. And there could be a lot of money left on the table and a lot of mistakes made. So really carefully look at the tax planning side of not just your business, but also the personal side of the house. But one of the things we want to recommend is just like, how would you create a disruption solution? What would you do? What would your blueprint be for your company? We're going to get into recovery, stabilizing, and growing. We're going to go through fairly quickly, but do you also have a contingency plan? So what's the plan? What's the contingency plan? And is there another default? These are things that normally in a great business environment, you can kind of flow and it kind of works well. In this case, we got to add and plan for a little bit of uncertainty because we really just don't know what's going to happen. The value reconstruction process we're talking about, look, this isn't like a software package you can buy or something, by the way, just to make that clear. So we're not selling a package of something. But you look at where a company's at, and look at some of your clients as well. Where are they at? Are they in recovery mode? How do they get stable? And then what are their growth options? Because if they can't get themselves settled here, and by the way, there's a lot of companies that are struggling. Conversely, there's a lot of companies that are killing it and growing. You got a lot of these distribution companies right now, delivery companies, they're just nailing it. In some of the other, obviously if you're on the restaurant side of the house, that's not doing so well, bars, restaurants, more hospitality related. So look at these options. So look at your short-term options first when you're looking for recovery. What's the risk inside your current customer base from a revenue perspective? It could be the business model that they're in, that the client's in. It could be the age of the clients. It could be the financial stability. So just kind of take a good hard look at that and go, well, what if I lost this client? And then look at your top 10 clients, by the way. Figure out how much your top 10 clients contribute to your revenue component. And if it's not just your current clients, and if your business model revolves more around you getting fed from other referral opportunities or from forecasting it out to get to where you're need to get to in like 6 months, look at that. Look at your debt. Is there an opportunity here for deferrals and any kind of payments or rate restructuring? Right now, with interest rates dropping all over the place, there's a lot of opportunity to potentially renegotiate it. Conversely, though, there are a lot of people talking about renegotiating the rents right now. That's a difficult thing to do. I know some businesses up in the New York marketplace that are being told their landlords are actually approaching them saying if they'll stay for 2 more years, they'll drop their rent by 25%. But that's a very decimated market right now. Others, it's a little more difficult to get out of their leases. Forecasting, what if models? What kind of cash reporting? If you have cash reports that are coming on a frequent basis and really give you like your worst case scenario, so you've got different multiple levels. The tax projections Bruce talked about are vital because even if revenues are flat or down and you can take advantage of tax incentives, you can still make a good year or a decent year out of what may be a more difficult year. And if you're really doing well this year, how do you find a way to defer some of that liability and push it out? Look at those contingency plans. That's the recovery side. This part, though, think about this one. Before COVID, business was good, economy was great, things were going well. Nobody's talked about these things. Okay, there was no PPP. The NOL carrybacks didn't exist. So there were a lot of things that have changed. Look at where you were a year ago, of what was important to you then, and determine what do you really need now going forward? What are your critical success factors inside the company? They likely have moved. And then what would be the key performance indicators you need to track now that are in alignment with your new success factors moving forward? At the same time, a little bit of plug for the accounting side of the house. Look at your accounting systems. If your accounting systems can't capture that data, can't produce those key performance indicators for you, you may need to look to switch around how you do your processes, your technology. This is really kind of key. This whole thing about tracking indicators and monitor progress, if you start missing your numbers, your indicators frequently, you probably need to look at those contingency plans or look at how you can adjust and modify rather than wait for it to hit you. Last thing we want to talk about here is how to look at growth options, except for when you get too far ahead, you miss that page. So let's look at the growth options. So in a good economy, you don't have to look for growth. It comes to you, okay? The accounting profession is a really good example of that. The accounting profession has had a staffing shortage for a decade and a half. Had a lot of tax law changes. They've had less people going into accounting. So, they've had a lot of work coming to them. It's been less having to look for work, more than process the work and train the people. So that's an industry that's looking at some change that's occurring out there. Most businesses right now are looking at some kind of, how do you look at alternative revenue streams? How do you look at your existing clients to maybe, I don't want to use the word sell them more, but to be able to offer them different services than you had before or different ideas. If you look at like a more traditional kind of outlet, how do you enhance that revenue per customer visit? Like if you go back to a restaurant, why does a restaurant, they serve you a nice meal, and if you get a drink or two, that's great. They continue to try and bring you drinks because it runs up the price per visit. In addition, they're going to offer you dessert. If they weren't doing that, their revenue per customer would be less. What can you do that's along that line? Now, I'm not suggesting that you serve drinks and dessert to your clients, because that probably isn't a business model, although you never know. So look at these options. Look at your core pricing servicing strategy. What is it? What's your core service, and what's the pricing strategy about it? Do you need to spend your time working on different kinds of clients that will give you a different kind of return? What's your outreach right now? What are you looking at for new prospects? What are you looking at for the next thing also on the referral partner relationships? And I would challenge you to look at your referral partner relationships and test them, okay? Is it a relationship, or is it more of an acquaintance? So a lot of people get those confused. Like, I've known somebody for years, he's a great person, great individual. Well, what have you really done with them? So you may fool yourself thinking you've got a referral partner relationship when really what you've got is an acquaintance. And you often have just a limited number of referral partners you can really actively manage at one time that are true referral partners. So spend your time wisely with the ones that are going to produce the most for you, and the ones you think that fit where you're going as a company. When we look at like this whole concept of like the pandemic and restructuring, it's difficult. Nobody wants to face change. Change is an ugly thing. Okay, no, it's just easier to kind of do what you've been doing all along. It's the easiest thing to do. But at this point, you really have to look at where the business is at, where it's going, where you see the whole industry you're in going, and how do you get ahead of the curve? Because the curve's coming no matter if you want to embrace it or not. So just look at that. I'm going to leave you with just Bruce at the end here, because he's the really smart guy. Seriously, Bruce is a really good professional, can help you out, help out some of your clients, help out some of your referral partners. We are very deep in the real estate industry. We know it. We've got, we'd love to talk to you about any of the ideas with your business, look at alternatives. Bruce, any final comment, thoughts?
No, appreciate everybody's time today. It is unusual times. Hopefully everything's going to be back together next May or June, and be back to normal so we can enjoy our summer. But in the meantime, let's all make sure we're able to stay safe, and I hope everybody has a wonderful holiday season coming up here. And if there's ever any questions or concerns, or you'd just like to maybe get a second opinion, feel free to reach out to me. Do we have any questions from the attendees that we can answer at this point in time?